Hi, I'm Corey Wastle, founder and one of the financial advisors here at Verse Wealth. Now, as you well know, last night the Treasurer, Josh Frydenberg, handed down his first post-COVID budget. Our first budget, in fact, since way back in May 2019. Doesn't that feel like a lifetime ago? The headlines from the budget, of course, are around all of the measures, 98 billion of them, in fact, to get our economy moving and get us creating more jobs moving forward. Now, in terms of our video today, we're not going to cover all of those new measures. We are going to cover what we think are 5 to 6 of the most important agenda announcements from last night across personal income tax rates and incentives for businesses to invest in new team and new equipment. I am joined, as always, by Ashley Bishop, one of the advisors here at Verse. Ashley, thank you for joining us. First things first, let's dive in. Of course, we've got to pay for all of these new measures. Our debt is going to be rising. Tell us, where's it rising to and can we afford to pay it?
Yeah, look, our debt, and thank you for having me, Corey, but our debt is going to reach effectively $1 trillion in the near term, which is record debt. We're going to run record deficits, so effectively spending more than we're earning in the short term to really fund the measures announced last night. In terms of whether we can afford it, we have to remember that interest rates are incredibly low, so historically low. So just like an individual who has debt can pays their interest rate, which is low, which makes it more affordable, the same goes for governments as well. So the affordability shouldn't be as much of a concern, even though the numbers are pretty eye-watering. In terms of, I guess, where our debt is, just as a comparison, up here I've got a chart you can see that shows government debt as a percentage of GDP, so how much debt we have compared to how much we're producing in the economy. Australia's debt to GDP is expected to reach around 55% by 2030. As a comparison, in 2019, so the UK, Spain, Italy, Greece, other European nations are far in excess of that 55%. I mean, the UK is going to be, this is in 2019, is heading closer to 100, as was Spain. Greece, even last year, was at 180,000, and we know the issues they've had. 180%, sorry. So ultimately, you know, the debt sounds like a lot, and it is in a way, but it is affordable, and compared to others, it's not nearly as high.
Well said. And importantly, those levels you were just showing, they were pre-COVID-19 levels. So budget deficits have blown out a little further since then.
Absolutely. And ours is going to blow out by 2030, that 55%. So there's the debt, as I say, the numbers are eye-watering, but the comparisons are pretty strong.
Yeah, thanks, Ash. Let's move along to the personal income tax cuts or changes. Now, this was proposed in previous federal budgets. Now, because of COVID-19 and the need to get things moving, these future changes have been brought forward. So step us through those changes, Ash, and what it means for our hip pocket in the short term.
No, absolutely. So I brought up a chart here that just shows the tax thresholds, where they were and where they're going to be. We can ignore this left-hand column. These are the old tax rates prior to the changes that were announced and then brought forward last night. The key columns are the second and the last on the right here. What is happening is the thresholds for when you pay these tax rates are increasing. So for someone who was paying 19% tax, they have to earn up to 37,000 a year. That rate is increasing to 45,000. And for someone who was paying 32.5%, they would have been paying that up to 90,000. Now you can earn up to 120,000 in a financial year and pay that 32.5% rate of tax. All these figures are plus Medicare of 2%. So it just means that for those in particular earning 90 to 120,000, so very much that sort of middle income, those people will receive in particular a strong tax reduction because they'll be paying, instead of 37%, that 32.5% rate. On a practical level, what that means, an individual earning around $80,000 can expect to receive an additional little over $2,000 in their hip pocket, which is great news for them. For couples earning around that sort of up to 250,000 figure combined, they might expect anywhere sort of up to $5,500 in tax back in their pocket. And the purpose of that really is because the government wants us to spend that money on businesses and help stimulate the economy that way. So getting money back in the pocket is really positive. In terms of when that happens, the government intends to legislate that fairly soon for that to happen from 1 July this year just gone. So Labor has said that they're going to help push that through as well. So we'll start to see the effect of that pretty quickly.
So what that means in practical terms is that your take-home pay from your employer in the short term, once legislated, of course, is going to jump up. And when you do your tax return for the current year, 2021, you're going to get a larger refund than you would have otherwise gotten because the tax rates have reduced during the course of the year. So
yeah,
I think that's good news for basically every working Aussie out there, and these amounts aren't amounts to be sneezed at. So thanks for the rundown, Ash. Let's shift gears a little bit to one of our favourite topics, that is superannuation, of course. There aren't major reforms to superannuation, which is probably a good thing for plenty of people out there. There's always plenty of changes to super. There are some improvements that the government is making to the superannuation system. So tell us a little bit about those changes if you can.
Yeah, absolutely, Corey. One of the major changes is that people are now going to have a super fund stapled to them. What that means is that when you change jobs, instead of having to sign up your super fund or have your super fund be sort of signed up with your employer, that'll just happen automatically. So that instead of your new employer potentially, and particularly for younger people, potentially just making contributions to their preferred fund, they'll have to make those contributions to the fund you already have. It's going to avoid sort of duplication, people having multiple accounts, which means they're paying multiple sets of fees, potentially multiple insurance premiums. So it's going to have a really positive effect on just the simplicity of the system at the end of the day, and reducing some of the admin burden and fee burden as well. It was recommended in the Hayne Commission a couple of years ago. So yeah, really pleasing to see that that's coming into force from 1 July 2021.
Well said. And in addition to that, the government is improving the transparency of the superannuation system by establishing what they're calling Your Super, which will be a website. It will be a comparator tool, basically, where you can compare funds using performance data as well. They're also going to subject superannuation funds to performance tests on an annual basis. So we'll know who are the poor performing funds and we can all leave them. And they're also going to increase the requirements for these superannuation funds to disclose what their underlying assets are. So you know where your member balance and where those dollars are actually being invested, which I think is a great thing. The more transparency we get, the better system that we're going to have. So good news on the superannuation front. I will keep us moving, Ash. Let's shift gears from individuals to businesses. Of course, plenty of the policy is targeted at business to raise confidence, to raise investment, and to raise employment. Young Aussies under 35 are one of the groups most impacted from an employment perspective by COVID-19. So there is some new stimulus referred to as Job Maker to have more businesses out there hiring Aussies under 35. How does that one work?
Yeah, look, there are a couple of different ways they're doing it, Corey, but in terms of the Job Maker, they're effectively going to provide credits in terms of literal cash payments to businesses who hire young Australians. So for a business that hires an Australian between the ages of 16 and 29, they're going to provide $200 a week as a credit for that business. For those being hired at the 30 to 35 age bracket, the government will provide $100 a week as a credit to that business as well. So it's effectively putting cash in businesses' pockets to hire young Australians, which is really positive. That's in addition to the wage subsidy for 100,000 apprenticeships that the government announced last week. That effectively means that they'll top up half of the wages of those apprenticeships, so that businesses can take those young Australians on. So a lot in there for young Australians, but as you noted, they have been hit hard by the COVID sort of downturn due to the industries that young Australians traditionally find themselves in at the current time. In terms of that, just a couple of points on that. Those Australians generally have to be on job seeker. They have to be new jobs as well. So there are some sort of caveats to it to make sure that these are unemployed Australians returning to work. Those jobs also have to have a minimum hours of 20 a week. So the idea being that they're not just sort of, I guess, token jobs. There have to be additions to the payroll. There have to be a certain number of hours to make it viable. There are some potential issues in terms of does a business hire 2 part-time workers instead of 1 full-time worker? But at the end of the day, there are always going to be unintended consequences, and the idea behind the policy is certainly a positive one.
You stole the words right out of my mouth, Ash. Very well said.
Great one.
In terms of businesses, before we leave them behind, 2 other important measures. Number 1 is what's called the carryback losses provision, which basically means for businesses that were previously profitable, the losses that they may now be making, of course, most likely due to COVID-19, rather than saving those losses and that reducing the tax on future profits, it's basically going to work in reverse, where they can take the losses that they're making now and they can get back the tax they paid on previous profits from financial year 2018 onwards. So this isn't basically costing the government any more money. It's basically getting these tax credits into the hands of business owners sooner. So I think that is a great one that's going to put more money in businesses, in their accounts, make them more stable, make them more likely to retain employees and hire employees. Now, the second one along similar kinds of lines is the instant asset write-off. Most people are going to be familiar with that name, at least. It's been quite common in the last couple of budgets. When COVID first happened back in March, April this year, the government increased the instant asset write-off threshold up to $150,000. Now, what that basically means is that if you are a business owner and you want to purchase some new plant or equipment or an asset to help you improve your business, either grow it or make it more efficient or more profitable, instead of claiming the depreciation on the asset incrementally over the life of the asset, you can claim all the depreciation in that first year, which is pretty neat. And it's going to have plenty of business owners out there buying things they may not have otherwise purchased. But it's important to note that if you don't need the asset, don't go and buy the asset. You get a tax deduction, which means you reduce your taxable income and ultimately your tax payable. You don't get the money back. So if you're spending 50 grand, you don't get 50 grand back in your account. That is really, really important to understand. So plenty of things there for businesses, plenty there for individuals as well. As we said earlier, $98 billion of really stimulus coming through tax cuts and business incentives to get our economy going, hopefully post COVID-19, particularly here in Victoria. We've got a debt we're racking up. It seems as though we can afford to pay it, according to Ash, which is great news. And to all the Aussies out there that have been doing it tough due to COVID-19, and there's plenty out there. We hope that the budget last night comes as some welcome news to you, and that things are on the improve for you, your family and communities as fast as it can be. So thank you for joining us. Thank you for listening. We hope you got some value from the commentary, and we shall speak to you all soon. Take care and good night.